Howdy, Jacob here. Today we're looking at Everi Holdings in the hotel, restaurant, and leisure industry. Looks like they develop and supply entertaining game content, gaming machines, and gaming systems for land-based and iGaming operators. Okay, founded in Las Vegas, 1998, and 1.1 billion market cap, 1.5 billion enterprise value. Their revenue growth has looked pretty cyclical. Looks like they had a pretty big hit from COVID, but have been growing pretty impressively since then. Something changed between 2017 and 2018. They lost 51% in revenue, but their gross margin increased a bunch, operating margin increased a bunch. So let's look at that. 2017 to 2018 on the income statement. Okay, we don't necessarily see a self of asset there. Balance sheet. 2017, 2018, I see no changes that would indicate something. Cash flow statement. Okay, well, that's just super weird. So I don't necessarily see something that would account for this. I would have assumed that they just sold off a very inefficient part of their business to where gross profit didn't change at all, but their revenue got cut in half. And so that's interesting that I don't see that, but very impressive operating margin. I mean, 20%, that is something to be very happy about. Return on invested capital still is poor though. Not poor. I mean, last 3 years, 13, 10, and 7%. I mean, that's pretty good, but averaging not immensely high. We didn't see any R&D. Oh, we did. Okay, that was the first line. Interesting. So their R&D expense is going to be 6 to 9% or so of their revenue. So they are taking money away from today to hopefully get more in the future, and they've increased it quite a bit. So they're starting to do some more R&D, and so to even still have those operating margins is very impressive in my eyes. We did see a little bit of net debt though, by that enterprise value being greater than market caps. Let's see, 267 in cash on hand, 6 million short-term debt, almost a billion long-term debt. So the good news is the long-term debt is down from 2014, so 1.2 billion down to just under a billion. But again, that's going to take some of your money that you could be, yeah, you got more growth in the past, but prospectively, you're going to have to focus more of your capital allocation on debt reduction, likely. And so what we see here is pretty volatile cash from operation, all positive, which is good in the last couple of years. But let's say $200 million, I guess, is just 5 years to get to your long-term debt. So as long as they don't increase that debt figure and are able to double their free cash flow, you're looking at a very reasonable ratio of free cash flow to debt, which I'm not terribly concerned with, or debt to free cash flow, sorry. Capital allocation is mostly acquisitions. They've been very consistent with net acquisitions from 2019 to 2023. And outside of that, we do see share repurchases and some debt reduction figures. And so I think I'm going to balance out what I want them to do with what they've done historically. When you have debt that they do about 5 years, even if you increase free cash flow, I don't mind decreasing debt with 5 to 15% or so of capital allocation, especially if you don't have those other opportunities to possibly get those great returns. And so I'm fine assuming 5 to 15% capital allocation to debt reduction. So that's going to leave maybe 20% to acquisition, 60% to share purchase. So a lot of that free cash flow is going to be buying back shares, inadvertently giving you money back as the investor. And so let's start making some assumptions here. I think 5% revenue growth seems pretty reasonable to me, maybe even 6 with some acquisitions here. And let's do market average. I mean, maybe they have better growth, but I don't know. There's just not a long history of these margins. And so this would be something, if I were to do a deeper dive, I'd be more comfortable with possibly doing a higher P and price to free cash flow. But at the same time, as of now, I want to be a bit on the conservative side because I want it to look obviously cheap in my eyes. So from a margin standpoint, maybe let's do 14 and 16%. I think that's due. Let's try 12 and 15% with a share change of 1%. It's going to be looking like $12 million. If they use $100 million, whoa, you could probably repurchase 4 or 5% of shares. And it looks like a buy right now. So this is going to have to be another company that I'm probably going to have to do more research on. I guess the only thing let's dampen that one due to their enterprise value being a little higher. But again, given at the end of 7 years, buying back a little bit of debt, yeah, I don't mind that. So I really don't mind these assumptions as of right now from what I'm seeing. And that would have this company look like a good price at this price point. So it looks like I'm going to have to do a deeper dive on Etsy, and I'm going to have to do a deeper dive on Everi Holdings, and hopefully have that out in a little bit because it looks interesting to me right now. Hope you enjoy this video.